Today, wages weakness continues to play out as confidence falls. Hello again, it's Martin North from Digital Finance Analytics. Welcome to the latest posts covering finance and property news with a distinctively Australian flavour. The Australian Bureau of Statistics released their latest wages data today. The Trend Wage Price Index rose 0.5% in the June quarter and 2.3% through the year. These are lower than projected in the budget and highlights the stresses in the economy. In fact, without one-off factors, the numbers would be even lower. Looking in more detail, the June quarter has brought a very modest lift in wage inflation. The seasonally adjusted read lifted 0.6% compared with a market expectation for a 0.5% rise, and that's up slightly from the 0.5% rise in the March quarter. This held the annual rate flat at 2.3% over the year, which is a small lift from the low of 1.9% in 2017, but it's still very low. So no joy to the RBA here. Our surveys suggest that this weak wages growth is absolutely endemic for now. In the second quarter, the total hourly wages before bonuses rose 0.61%, with a 0.54% rise in private sector wage rates and a very solid 0.82% rise in public sector wages. That's the largest quarterly rise in public sector wages since the first quarter of 2014, but this followed the smallest quarterly rise in public sector wages since March 2000 of 0.45% in the last quarter, and that may suggest more volatility in this series. It was flattered by the largest increase in public sector wages in Victoria at 1.5% because of uplifts in the health sector. And in the quarter, there was a more average rise in Queensland at 0.5% and a below average rise in New South Wales at 0.2%. Private sector wages came in at 0.54% in the last two quarters, so the annual pace eased back to 2.3% over the year from 2.4% back in March. Public sector wage inflation lifted a little to 2.6% over the year from 2.4% to be back on par with the recent peak of 2.6% over the year in September 2018, but this does not suggest any reason to suspect a wages breakout is hiding anywhere around. Wage inflation is still well contained and remains under the historical average. In the June quarter, Victorian wages lifted at 0.7%. That's stronger than the 0.5% gain in March, but a moderation from the 0.8% in both the third quarter and fourth quarter of 2018. The annual pace of Victorian wage inflation has lifted to 2.9%, and that's the fastest pace for any state and the fastest pace in that state since September 2013. But contrast that with New South Wales, where wage inflation was flat at 2.3% over the year. Here there's been a longer history of a tighter labour market, and yet it has failed to generate wage inflation as it has in Victoria. Private sector wages, including bonuses, continues to run at a faster pace than the measure excluding bonuses, 2.4% compared with 2.3% over the year respectively. But the pace has slowed from a recent peak of 2.7% in the fourth quarter 2018. As the pace of economic activity slows, this modest pressure is easing, suggesting the pressure on variable compensation is unlikely to be transferred to fixed compensation anytime soon. By industry, the fastest gains in wages are still in what you might consider to be the non-cyclical sectors such as healthcare at 3.3%, arts and recreation at 2.8%, public administration at 2.5%, education and training and other professional and scientific, the last three at 2.4%, and the slowest wage growth remains in the cyclical industries such as wholesale trade at 1.7%, retail trade and construction both at 1.9%, and manufacturing at just 2%. Even in mining, where there is some talk of a modest recovery in investment and talk also of emerging shortages of skilled labour, wages are growing at just 2.2%. So overall, this result confirms the weaker trends, and the government's budget expectations are way stronger than reality. Thus, the recently revised RBA projections will need to be revised down again, and households, I think, will remain under extreme financial pressure. And this was confirmed when ME Bank released the latest edition of their Financial Comfort Report. They said that Australian households are feeling overall worse about their net wealth, jobs, income and living expenses, with further significant residential property price falls over the past 6 months and a weakening labour market. Despite remaining a little above the report's 7-year average, financial comfort across most of the 11 drivers that make up the index fell, with net wealth in particular seeing the largest drop, falling 3% to 5.54 out of 10 during the 6 months to June 2019. And this is largely a consequence of continued decreases in the value of residential property in many parts of Australia. Comfort with wealth would have fallen much more if it wasn't for record bond prices and rebounding share markets, as well as the government's retention of negative gearing on investment properties and cash refunds for franking credits that saw household confidence with investments increase. Financial comfort among households also eased as a consequence of a weakening job market, which resulted in subdued wage growth, falling comfort levels with income, and high levels of both underemployment and job security. In particular, financial comfort among working Australians significantly deteriorated, with full-time workers recording a 3% decrease to 5.86, part-time workers decreasing 4% to 5.1, casual workers decreasing 1% to 5.02, and self-employed workers down 3% to 5.57. In June 2019, 35% of part-time and casual workers said they would prefer to work more hours, seeking an additional 23 hours per week. Meanwhile, 26% of all workers said that they felt insecure in their current job. Households' comfort with their incomes also fell by 1% to 5.69 in the latest survey. Only 36% of Australian households reported an increase in their annual income during 2018-19, falling 2 points from December 2018, and there were fewer income gains recorded across households in general. High-income households also continued to be much more likely to report increased incomes during the past year. In net terms of the greatest financial worries and positives, cost of necessities was the most commonly cited worry in ME's latest report, nominated by 44% of households. This was followed by worries about levels of cash savings on hand at 34%, ability to maintain lifestyle in retirement at 31%, and the impact of legislative changes at 19%. About 40% of households continue to spend all of their monthly income. When asked about retirement, the anticipated standard of living in retirement has eased, falling 1% to 5.2, and notwithstanding a rise in the comfort of households expecting to self-fund their retirement, up to 7% to 7.31. Furthermore, of all 11 components that make up the Financial Comfort Index, Australians still felt the least comfortable with their ability to cope with a financial emergency, which fell slightly by 1% to only 4.77 out of 10. Indeed, 20% of households said they didn't think they could raise $3,000 in an emergency. While the residential property price correction has negatively impacted wealth, comfort by housing tenure has been mixed over the past 6 months. The report reveals that comfort has lessened among both homeowners with a mortgage and renters, which could be attributed to the tightening in the availability of credit, continued housing unaffordability, and high household debt and rental payment stress. In contrast, comfort has risen among those who own their home outright and geared property investors post-federal election, with negative gearing retained on investment properties. The number of households contributing more than 30% of the disposable income towards paying off a mortgage has remained steady at around 43%, while the corresponding figure for renters has risen to 62%. In contrast to the actual fall in dwelling prices during the past 12 months, the majority of households living in their homes and investment property investors are feeling even more positive than 6 months ago about the 12-month outlook for dwelling prices. In fact, over 41% of households living in their homes expect their dwelling price to rise during 2019-20, while only 11% expected the value of their homes to fall, including only 3% who were expecting a large fall. However, the expectations of higher home values among home owner-occupied varied significantly across the major capital cities, with a significant rise in Brisbane 46%, Sydney 45% and Melbourne at 42%, in comparison to Perth at 25%. Investors are relatively more optimistic than owner-occupiers, albeit less so than 6 months ago. 46% of investors expect the value of their investment property to rise during the next 12 months, while only 9% anticipated a fall. And that included 2% who anticipated a large fall. Investors in Sydney are the most optimistic about property values, with 54% of investors expecting rises and only 6% expecting a fall, followed by investors in Brisbane at 50% and in Melbourne at 44%. So standing back, I think we can see that wages growth, or the lack of it, and household confidence are linked consistently. But what is interesting is that expectations with regard to future home prices looks to be on the rise. And later on, I'll be reporting my own survey data, which is beginning to show some similar trends. Now, of course, the question is, are those home price expectations built on reality, or sentiment, or both? I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.